Hello, my name is Luke Allshorn and I'm the Business Development Manager for the Toronto Stock Exchange and TSX Venture Exchange for Australia and Southeast Asia. I'm based in Sydney, having started the role in September 2023, and it is my pleasure to present today to the Wholesale Investor Capital Masterclass Conference. I'm grateful to Steve and the Wholesale Investor team for the opportunity to walk through and educate this audience about the Canadian equity market ecosystem, the benefits of being listed on one of our exchanges, our listed innovation sector universe, and our innovative capital pool company program, which is a unique Canadian invention that supports earlier stage private companies complete a transaction to go public. So let's get into it. Canada is made up of 10 provinces and 3 territories, the world's second largest country by total area, and is inhabited by 40 million people. The capital is Ottawa, and its 3 largest metropolitan areas are Toronto, Montreal, and Vancouver. Canada is a parliamentary democracy and a constitutional monarchy in the Westminster tradition, and it is highly ranked in international measurements of government transparency, quality of life, economic competitiveness, innovation, education, and gender equality. Canada has a high nominal per capita income globally, and its advanced economy ranks among the largest in the world, relying chiefly upon its abundant natural resources and well-developed international trade networks. So TMX Group owns and operates Toronto Stock Exchange, TSX, and TSX Venture Exchange, TSXV, and companies listed on our exchanges have access to one of the world's largest capital pools. The North American capital markets provide access to a wide investor base and strong liquidity. The exchanges serve as an access point to North American and international markets for public companies seeking growth and expansion capital. TSX and TSXV's significance as world-class equity markets is reflected in the broader strength of the Canadian economy. Canada's economy is broadly diversified with key strengths in manufacturing, financial services, and technology. This, coupled with Canada's political stability and diverse natural resources base, including oil and gas, coal, nickel, copper, zinc, uranium, lithium, and diamonds, makes Canada a viable destination to raise capital and leverage Canadian financial expertise. Some of the world's largest asset managers and financial institutions, including Canadian institutional investors and super funds that manage a cumulative $6 trillion of assets, actively trade on TSX. And it's worth noting that 40% of daily trading originates outside of Canada, and a quarter of our member firms are also headquartered outside of Canada. We believe roughly 75% of that 40% of trading outside of Canada comes from the United States. There are roughly 3,500 companies listed across both our exchanges, almost split half and half, for a total of around $4 trillion of market capitalisation. TSX includes the big banks like Royal Bank of Canada, TD and BMO, but also more familiar names like Shopify, Brookfield and Thomson Reuters. The Junior Venture Exchange hosts the likes of Topicus.com, Sigma Lithium and Patriot Battery Metals, which is also dual listed on ASX. The Australian and Canadian economies share a lot of similarities, as do our stock markets, with a diverse spread of companies across sectors, including financial services, mining innovation, industrials, and energy. There are currently over 250 international companies listed on TSX and TSXV, with Canada's southern neighbour making up half of that number, while South America and the UK, Europe have around 30 international companies listed. Our region speaks for about 23 companies, mostly in miners and explorers, and most of these are also dual listed on ASX. From 2018 to 2022, there were 122 IPOs and new listings, and about $24 billion in equity capital raised by international companies. Our exchanges were ranked second among global peers for new international listings, according to the World Federation of Exchanges. TSX and TSXV are the #1 destination for US companies to list outside of the US. Traditionally, TSX and TSXV have been seen as global mining exchanges, seeing as we have over 40% of all global mining companies listed on our exchanges. But increasingly, as you can see from this graph, growth sectors account for 40% of market capitalisation. Growth sectors include clean technology, life sciences, technology, and diversified industries. While TSX and TSXV will always be considered very strong places for mining companies to list, this diversification speaks to wider opportunities for other sectors to seek their companies to be listed in North America. The Toronto Stock Exchange is recognised as a premier international stock exchange, known for its standards of fairness and its innovative approach to trading. TSX is the right choice for companies with a solid track record of business management and operation. TSXV is a public venture capital marketplace for emerging companies. It provides a marketplace where growth companies can raise capital to develop and market their properties, products, and services. For investors, this exchange provides opportunities to seek early-stage investments in growth companies. For companies, TSXV offers tailored listing and corporate governance requirements for small-cap companies, as well as an extensive mentorship program for newly public companies. On this slide, we can see the difference in financing size across the two exchanges and relative size difference between listings on TSX versus TSXV. TSXV companies also have a clear path to graduate to the senior exchange, and we will touch on this process now. Companies listed on TSXV are provided with the opportunity to gain a solid foothold in the public market, with the option of working towards graduation to the senior exchange and gaining access to larger pools of capital, more international institutional investors, and greater analyst coverage and visibility. TSXV offers companies a flexible system whose initial listing requirements are tailored to a company's industry sector, stage of development, financial performance, and most importantly, operational resources. There is a streamlined process for TSXV companies to graduate to the senior board if they qualify under the listing rules. And as we can see from this slide, over 750 companies have graduated to the senior board. 84 of those now have market caps above 500 million Canadian dollars, and the innovation sector make up the majority of TSXV graduates to TSX. There are a number of ways to list on our exchanges via qualifying transactions through the CPC program for financings of $1 to $10 million, or SPACs with financings of $30 million and above, IPOs, reverse takeovers, or as the majority of Aussie companies are currently, dual listed on ASX, where we currently have 19 companies like Allchem, Perseus Mining, and up until recently, Newcrest Mining. Interestingly, a large majority of our innovation companies listed on TSX or TSXV via qualifying transactions through the CPC program, which we will get into shortly, but it's also worth noting that IPOs, reverse takeovers, and change of business are avenues to list on our exchanges. So let's take a closer look at the innovation sector now, and also within that, the technology sector on TSX and TSXV. In the period 2018 to 2022, over $62 billion was raised across the innovation sector on TSX and TSXV, with more than $850 million raised in the technology sector in 2022. We had 258 new IPOs and listings over that 5-year period, including 17 new technology listings in 2022, making the innovation sector the #1 sector for new listings, as well as the #1 sector for non-Canadian IPOs and new listings. Within the technology sector, our TSX and TSXV companies raised $29 billion from 2018 to 2022, which included 135 IPOs and new listings. And in this table are some examples of those financings. These companies represent the diverse range of tech companies on our exchanges, including e-gaming platforms, digital car auction platforms, blockchain infrastructure solutions, and safety and monitoring technology. The list of Canadian and international TSX and TSXV listed technology companies is dominated by Shopify, with a $102 billion market cap, 52 equity research analysts covering the company, and is also dual listed or interlisted on the NYSE. But there are a few more familiar names, including Constellation Software, OpenText, and of course, one of the original tech companies, BlackBerry. You can see that quite a few of these companies have listings on the US exchanges, which complement the Canadian listing and is something we'll be talking about shortly. So let's consolidate at this point. After looking a little deeper at the Canadian economy, the TSX and the TSXV exchanges, the Canadian equity market ecosystem and the innovation and tech sectors within it, what do these very solid foundations mean to you, the founders of your company, in choosing to go public and where you choose to list your company? From here, we will be looking into the reasons to list, the benefits of a North American listing in Canada, the listing process and timeframes, and finally, how your company could be financed by the CPC program to get listed in North America on the TSXV in an efficient, cost-effective manner. Finally, we will also showcase one of our Aussie success stories through the CPC program, Graphene Manufacturing Group out of Brisbane. So here are some of the main benefits of listing your company on TSX or TSXV. For mine, for an Australian audience, the enhanced investment profile of your company to one of the largest, deepest capital pools on earth is a major reason. Equity analyst research coverage at an earlier stage helps your profile. When compared to the US exchanges, lower litigation risks, shorter timeframes, and cheaper processes to list are also major differences when listing in Canada. If down the track, the company is still keen to list in the US, like quite a few of the tech companies we saw earlier, then TSX and TSXV offer a great stepping stone for companies who would then have had experience in the North American capital markets. The Growth Accelerator program, which we will look at in greater detail shortly, is another big advantage and available to all new listed companies and sets us apart from other exchanges globally. So I think it's worth highlighting at this point that not all Aussie technology companies are the size of Atlassian or Canva. Not all life science companies are the size of CSL, and nor are there many Aussie mining companies the size of BHP. The TSX and TSXV fill a niche for small to medium-sized companies to list in North America, be introduced to that equity market ecosystem of investors, research analysts, and bankers, while at the same time being able to access that massive pool of capital available in that geography. This slide speaks to the relevance of size in Canada versus the US exchanges, where due to the size of the companies on their exchanges, the Apples, the Microsofts, Nvidia and Googles, it's very easy to be too small to be noticed if your company is small or medium-sized. Our exchanges also do not have arbitrary minimum share price levels that need to be maintained in order to stay listed. At every stage of our small to mid-cap issuers development, TSX and TSXV companies have a higher number of equity research analysts covering them than their peers on the US exchanges. This increases the visibility of the company across the market and therefore the attention of North American investors as this company research is distributed across their client platforms. It's worth pointing out that the exchange is also able to offer introductions to research analysts, bankers and lawyers in order for issuers to start a dialogue with this cohort of market stakeholders. So this slide is a pretty stark reminder of the litigiousness of the US market and something to be considered by all Aussie founders, boards and management prior to choosing a listing venue in North America. In an environment where director and office insurance is skyrocketing in the US, adding to listing and annual maintenance costs, the spectre of investor disenfranchisement due to company missteps or miscommunication, which leads to legal action, cannot be understated. I will point out that Canadian director and officer liability is capped by statute. Going public on TSX or TSXV is typically a cheaper exercise than on the US exchanges, illustrated by these graphs, where a $50 million market cap company can list on our exchange and still have change in the bank from $1 million, which is not the case in the US, where the starting price for the same size company is closer to $2 million. A mid-cap $500 million company is typically looking at a legal, accounting and regulatory bill 4 times the size of listing on one of our Canadian exchanges, and the timeframes are typically longer, which we will look at in the next slide. So while the IPO market around the world is currently in hibernation, when the window opens again, the time periods to list your company may be shorter, meaning being organised and having the paperwork done is time sensitive. It helps to understand the relative regulatory reviews of your company's IPO application by the regulators in North America. So when the time comes to hit go on the listing, the company and its advisors are prepared and can take that timeline into consideration. Speaking to the pragmatism of the Canadian equity markets, our regulatory review periods are much shorter than the US exchanges. So not only is it cheaper to list on TSX or TSXV than the US exchanges, the process to get your company quoted on our boards and trading is and will be much faster. So let's talk about stepping stones for those founders and companies intent on listing their company in the US. The Multi-Jurisdictional Disclosure System, MJDS, was adopted jointly in 1991 by the US SEC and the Canadian Securities Administrators. The agreement makes it easier for companies on both sides of the border to list their stocks on exchanges in both countries. Under the MJDS, the SEC accepts documents prepared for its Canadian counterpart for review of applications to sell securities in the US markets, with minor additions. The effect of the MJDS is to make it significantly easier for Canadian companies to raise funding through securities offerings in the US as well as in Canada. The MJDS speaks to the stepping stone aspect of listing on TSX or TSXV, where down the track, eligible companies can use the MJDS to add a listing on NYSE or NASDAQ if they see fit. Around 83 companies added a listing on one of the US exchanges to their TSX or TSXV listing in the period 2018 to 2022. Let's talk about the Growth Accelerator program now. As the head of our company services team told me when explaining the Growth Accelerator program, he said, "We want to make better public companies." So our team will help newly listed issuers navigate the public market via the Growth Accelerator program, which are one-to-one sessions across 6 different modules of an hour each, covering really important aspects of being an executive of a public company that has responsibility to investors, regulators, and other market stakeholders. The sessions are complimentary and cover governance, ESG, IR, investor relations, disclosure, trading, and follow-on transactions. You can pick and choose which modules you enroll for, or do all of them, in order to be better educated around being an executive at a good public company. So now I want to flip to spending some time walking through the Capital Pool Company program, or the CPC program, which is a unique listing vehicle that can make particular sense for smaller companies going public regardless of their sector. The program connects experienced investors with private companies by dividing the traditional IPO process in 2, the creation of the CPC, public vehicle shell, and the qualifying transaction, the QT. The reasons that a company would consider a qualifying transaction, a QT, with a CPC are: it provides a going public process that has greater flexibility, more certainty, and allows more control over the process by the company that is going public. With over 2,800 qualifying transactions completed, the process of going public is well structured and well understood by market participants. A QT can mitigate certain market risks inherent in an IPO. It connects a growth company to experienced corporate directors that can be long-term investors and directors for the company that will help bridge the company to the public markets. And the financing of the QT is not required to have the broad distribution of an IPO. The CPC structure attracts investors across the spectrum, including high net worth individuals, family offices, retail investor clients of brokers, and small cap asset managers in North America. The companies that have been formed into the CPC cover all industries, but have been particularly attractive for companies across the technology, healthcare, consumer products, fintech, manufacturing, and resources. The CPC program has been operating in Canada successfully for over 30 years, and in that time, over 2,800 CPCs have been created, 85% of which have successfully completed a QT. 35% of the graduate issuers on TSX are former CPCs, which illustrates the companies that stem from the CPC program can be very successful. The popularity of CPCs is growing each year, and we currently have around 150 CPCs listed on TSXV that are looking for good companies to invest in. Speaking to the size of the program, almost $3 billion was raised by former CPCs last year, demonstrating the financing capabilities of these vehicles. So we'll step through some calculations in forming a CPC shortly, but here we have the basic structure of the vehicle, including seed capital, directors and officers input, and distribution criteria, including 150 public shareholders and 500,000 free trading shares. Generally speaking, CPC founders are experienced public market deal makers looking to invest in quality private companies with a strong management team that they think can translate into a successful public company. From the private company's perspective, they are attracted to ongoing financing capabilities from their shareholders to drive their strategy and growth plans. The new company can also use the company's scrip as acquisition currency as part of their growth plans. Employee retention via company shares and options becomes a viable proposition for the new company and is a visible gauge of performance via the share price for employees. A QT is effectively a reverse takeover of a CPC by an operating business that will access the capital, shareholders, and expertise of the CPC to complete a listing on TSXV or TSX. It is the most common way that companies go public on TSXV, and the program has an incredible track record as an ingredient in the success of many companies that have grown to be leaders in the Canadian markets. Here we're looking at the steps in creating the CPC from the seed financing through to the public financing, the CPC acquiring a business via a QT, and then listing the new company on the exchange. The percentages used in this diagram are for illustration purposes, as the final numbers are a commercial negotiation between the CPC and the private company. But this diagram gives you a feel for the mechanics of the CPC. The founders seed and create the vehicle that finds a private company looking to raise capital and go public, which then results in a new public company with concurrent financing to list on the exchange. Every CPC can be different, but let's walk through an example to show the financing of the vehicle and how that works. In this example, we have three founders invest $35,000 each at 12.5 cents, and an institutional fund invests $125,000 at the same price. When this CPC IPOs, it has 150 new shareholders with in total 1.2 million shares at 25 cents each, in addition to the seed capital put in by the founders. CPCs can also have stock options and broker warrants, as per this example, but as I said, some CPCs will not have similar structures. The resulting share structure following the identification of the private company by the CPC, the negotiation of the QT, and signing of the agreement results in this equity table. We have the seed investors, the CPC IPO shareholders, the private operating company with a $30 million valuation and 74% of the listed company, and a concurrent private placement of 33 odd million shares at 30 cents. Visually, the workflow for the CPC transaction is represented here, with the CPC and its shareholders identifying a private company, negotiating a valuation with the private company, signing agreements for a qualifying transaction, conducting a $10 million financing, and finally, creating a new company, listed and trading on TSXV. Reflecting the pragmatism of the TSX and TSXV, the CPC program made changes over the last 2 years to reflect the wishes of the key market stakeholders to ensure the ongoing success of the program. These include maximum gross proceeds doubling to $10 million from $5 million. There is no longer a deadline to complete a QT. Finder's fees can be paid to non-arm's length parties to the CPC. Escrow periods have been revised to a standard 18-month period, and only 150 public shareholders are needed, down from 200. So 18 months ago, we started the Deal Portal, which is an online platform for CPC founders and bankers to review presentation decks from private companies in order to find deals. The TSX business development team is large and has a presence not only across Canada, but also the US, Brazil, London, Israel, and now me here in Australia. And we are regularly adding decks to the portal for the CPC founders to view. We can also provide a list of current CPCs and their best contacts in order to start an engagement if your company wanted to explore the possibility of listing via the CPC program. So in order to give the CPC program a bit of a local context, we thought it worth highlighting Brisbane-based company Graphene Manufacturing Group, who are a tech company listed on TSXV via the CPC program. Their current market cap is around $130 million. They have raised capital 4 times since listing in April 2021, averaging around $4.7 million each time, and their market share has doubled since the QT listing. Speaking to the team in Brisbane recently, they are really happy with the CPC process and are strong advocates for the program and how it has assisted their company's growth plans to have their shares listed and trading in Canada. So I'll conclude my presentation here, and again, thank you for your attention today. Listing your company on TSX or TSXV is a viable option when you consider the Australian-Canadian equity market ecosystem similarities and the fact it's a fantastic gateway to the massive North American capital pool in order to assist you and your company's growth plans. Please get in touch if you have any follow-ups on today's presentation, be it the CPC program or listing your company on TSX or TSXV. Thank you.